Hey, what's going on, everybody? So I want to teach you in this video all about business lines of credit. So let's just go to the basics. What's the difference between a loan and a line of credit? Well, a loan, they're going to deposit the entire amount that's on the agreement into your business bank account, and then you're going to pay it back over time, whatever the agreed upon time is. A line of credit is more open-ended, it's way more flexible, and really every single business needs a business line of credit. So the way a line of credit works is, let's just say you get approved for a $150,000 line of credit, and it's a 12-month line of credit. All that means is you can draw up to $150,000 at any point you want. Now, if you start the line of credit by only drawing, like, say, 50, okay, that first draw is scheduled to pay back over the next 12 months. All right. And at any time, you have access to the other 100. Now, as you pay down the balance, you have access to more capital, right? You have access to more funds. That's why lines of credit are so important. And typically, if you pay a line of credit back early, right? Let's say you only have it out for 2 months, you're only paying at that point the principal. Every payment's going to be calculated to pay principal and interest. But if you pay it off early, you're just going to pay back the principal, and all the remaining interest is forgiven. Right? You're only paying on it what's drawn over how long it's drawn for. So it's, again, very flexible program. Now, let's go into how it helps and why you need it. Well, the easiest way to put this is you need it for short-term opportunities or anything that comes up. Okay, so when I say short-term, it's going to be things that you need every single month, such as inventory, supplies, adding people to the staff, marketing, any of those things that you need either every day, every week, every month, every quarter. All right. I would tell you, if you need equipment or you want a down payment for a building or things of that nature, there are better programs for that use. Okay. But for a line of credit, you need it. I'll give you a couple examples in a minute. Next, the other reason why you need a line of credit is just in case something happens, right? So let's just say you get an unexpected bill from the IRS. You need to be able to draw funds and not deplete your cash in the business. So that's why a line of credit can help in those situations. Or let's say something breaks, okay, or you run out of inventory, right? You want that line of credit for these unexpected things that can, hurt the business and hurt the cash flow. So, I'll give you guys a couple of examples. I have a friend, his name's Mike, got him set up for a business line of credit. Right after we got him set up for that line of credit, one of his competitors down the street decided that they were going out of business. Well, he was able to scoop up everything right away, all the inventory and some of the equipment, and even an employee, because he had access to financing. I have another client, Lauren. She owns a a retail spa, all right, and she had the opportunity to buy inventory at bulk to get a giant discount. So she was able to open a line of credit, draw on the line of credit, get the inventory at bulk, and that increased her margins. It also helps getting in front of some of these supply chain issues that we're seeing. All right. And then I have somebody, his name's John. He's been with me for 6 years. And his biggest thing is he wants to buy as many trucks as possible. He has a logistics company. He has been able to consistently buy trucks using equipment financing, but sometimes he has to float the money for the drivers. So what he does is he comes to us, gets the equipment financing, and then when he hires somebody, he pulls from the line of credit to cover their first 3 to 4 weeks in salary. And it works out great for him. He's gone from doing 150,000 a month to close to $1 million. Again, he's been with me 6 years, but having these programs in place allows him to grow and scale at an exponential rate. Now, let's go into what you're going to need. What are the qualifications to get a line of credit? You need to be in business at least a year. You need to be doing at least $30,000 a month that goes into a business bank account. You need to have good cash flow. What do I mean by good cash flow? Well, at least eight, hopefully 10 plus deposits. Okay, steady volumes or increasing volumes is preferred, but at least steady. And decent average daily balances. Average daily balances is just the amount that's in the bank account at the end of the day. Typically, or ideally, you want 10% of your monthly sales always in the business bank account. So if you're doing 30,000 a month, you want to keep 3,000 in there. If you're doing 100,000 a month, you want to keep 10,000 in there. That'll help you score out a lot higher on a risk analysis. In terms of credit, you want to have at least 650 credit or better. And then I have 2 lines of credit. There's 2 lines of credit you can get when you're in business at least a year. Once you're in business 2 years, those options open up, and the more underwriters are willing to look at it. Why? Because the longer someone's been in business, it shows that they're a better operator. Most businesses fail because they're not set up properly in the first year or two. Right? I hope that makes sense. If you have questions, give me a call. And now let's talk about the process, the application process. We can get a line of credit set up in as little as 24 hours. And all we need is an application, the last 6 months of your business bank statements. If you accept credit cards, the last 2 months of payment processing statements, a driver's license, a voided check, and your most recent business tax return. That's all we need. And we can get it set up in as little as 24 hours. Now, how do the terms work? They're simple. The higher you score out, the cheaper the rate's going to be. All right? They're either going to be 6 months, 12 months, 18 months, or 24 months. What do I mean by that? Well, if you get a 6-month line of credit, every draw that you make is scheduled to pay back within 6 months. On the other side, if you get a 24-month line of credit, every draw you make is scheduled to pay back in 24 months. And obviously, you could pay it off at any time. Rates start at like 5% and go up from there. It's all simple interest. So when you pay it off early, you get the full discount or remaining interest waived. And it will help you build business credit. All right. Now, how do they calculate how much you qualify for? Typically, they're going to take the last 6 months of business bank statements and they're going to come up with an average. So let's say you send in your 6 months of business bank statements and you're averaging 200,000. Well, they're going to give you anywhere between 25 and 75% of your average monthly sales. So think about it this way: if you're doing 200,000 a month, you could get anywhere between a $50,000 line of credit and a $150,000 line of credit. All right, and the repayment terms are usually either weekly or monthly, depending on which program you qualify for. And then now, how to apply? There'll be a link below, or you could reach out to me, Jonathan, at Integrated Business Financing. We can get you set up, make it a smooth, easy process, and really help your business to grow. If there's any questions that you feel I haven't answered, please reach out. I'm happy to answer them. And thank you for tuning in.